Assalamu alaikum everybody. Welcome back to my channel Rapid Revision. This video that I'm making today, it's from depreciation and disposals of non-current assets, and this particular question is from Edexcel GCSE Accounting. It's very relevant for O-level accounting as well, O-level and IGCSE, even for A-levels. But the past paper that I have chosen is from Edexcel GCSE. The question here says state one difference between capital expenditure and revenue expenditure. So capital expenditures are those expenditures that are on long-term productive non-current assets. However, revenue expenditures are those expenditures which are for day-to-day running of the business. So this you can write as a difference, but you can also write that capital expenditures are always written in the statement of financial position. So capital expenditures are always recorded in the statement of financial positions. Capital expenditures are always recorded in the statement of financial position of the business. However, revenue expenditures are recorded in the income statement. Okay, identify indicating with a tick how each item would be treated when a new motor van is purchased for use in the business. So they've given you some expenditures and you guys have to identify which one is a capital expenditure and which one is a revenue expenditure. So number one is installed shelving in the van. So you guys must know this already also that capital expenditures are one-off expenditures. So once you have bought the non-current asset and whatever expenditures you are making to make that non-current asset functional. So something like shelving, you will not do it again and again. It's not a recurring expense. Shelving is a one-off expense and capital expenditures are always one-off expenses. So you will record that as capital expenditure. We'll tick the capital expenditure column in this case. In the next part, they are saying motor insurance. Motor insurance is a revenue expenditure because it is recurring. You need to pay for the insurance every year. So you tick revenue expenditure in this case. Sign writing on a van. So you guys should know how sign writing looks like. So this is what I googled for you guys to see how sign writing looks like. So sign writing is like when you get a van for your business and then you let's say you are getting logo printed on the van. So that is basically sign writing, and you wouldn't do that again and again. This is a one-off expense, and obviously no business would do that again and again. So that is also my capital expenditure. Okay, the next part here says Guy prepares his financial statements to 31st January. So that means his year starts on 1st February 2021 in this case. But they have said on 1st February 2021, the balances on motor vans accounts per cost was 146,000 and provision for depreciation was 68,000. So this is the total depreciation at the start of the year. Total depreciation, also we call it accumulated depreciation. And the cost of all the motor vans at the start of the year is 146,000. So this is the first date on which you've gotten these balances for motor vans and provision for depreciation. The first date is 1st February 2021, and this year basically is going to end on 31st January 2022. Okay, then they're saying here on 1st August 2021, Guy sold a motor van that he had purchased for 36,000 on 1st August 2019. He received a check for 25,000 in full settlement. Then they are saying on 1st September 2021, Guy purchased a new motor van for 49,000 paid for by bank transfer. So they are selling one motor van and then they are also buying one motor van. Then they're saying motor vans are depreciated at 20% per annum using the reducing balance method. A full year's depreciation is charged in the year of purchase but none in the year of disposal. So this current year is also the year of purchase for the motor van that costed us 49,000, and it is also the year of disposal for one motor van that we are disposing of here in this case. Part C says prepare the following accounts for the year ended 31st January 2022. Motor vans cost account. So motor vans cost account, basically all values in the cost account are cost. So this is a very simple D account. You just have to simply record the purchase of a motor van and you have to also record the disposal of motor van and then calculate the balance carried on. So I'll write here 1st February 2021 is my start date. So I'll write here 1st February 2021 I'll write here balance brought down on the debit side. You guys should know that motor van's cost account is an asset account. Assets have a balance brought down on the debit side, and they have a balance carried down on the credit side. And they, whenever you are buying more assets, you record that on the debit side. Whenever you are disposing of an asset, you record that on the credit side. So this balance brought down is going to be 146,000. Then I need to record what I'm selling. So I'm selling my non-current asset on 1st August 2021, and this was initially purchased for 36,000 on 1st August 2019. So that means now I'm going to record this 1st August 2021, and this will, I'll write here disposal, because this is the disposal of the non-current asset. Basically, what's the first double entry for disposal? Motor van account credit, disposal account debit. So in this case, I'm going to remove the cost of my disposed of non-current asset, that is 36,000, the original cost. Originally, I had purchased this non-current asset for 36,000. I will remove this from this T account. Also, I'm going to record a new motor van that I have purchased on 1st September 2021. And for this, the double entry will be motor van account debit, bank account credit, because we are paying by bank transfer. So I need to record this on the debit side of the motor van account. I'll write here bank. In my bank account, I'll write motor van. In my motor van account, I'll write bank. So I'll write here 1st September 2021. I'll write here 49,000. So now what you're going to do is that you have to calculate the balance carried down. 146 plus 49 minus 36 is going to give you 159 as balance carried down. So I'll write here balance carried down. I'll write here 159,000, and this will be on 31st January 2022. This will be my balance. Now what I'm going to do is that I'm going to balance this account at 195,000 on both sides. So I'll write here 195,000, and on the credit side also I'll write here 195,000. This balance carried down will become my balance brought down, and this will be 159,000, and this date will be 1st February 2022. And that's it for motor van's cost account. It is that simple. So you guys need to know the rule. You need to record the purchases of non-current assets, that is in this case purchases of motor vans. You also need to record the disposal of motor van in this case, and disposal will always be recorded at the original cost. Please don't do that mistake of recording the selling price in the cost account. Please don't do that. A lot of students do that, but you need to record the original cost of the non-current asset. Originally, we had purchased this for 36,000. We are selling it for 25,000. That is a different thing, but the original cost must be recorded in the motor van cost account. Okay. In the next part, what you need to do is that you need to prepare a disposal account for this particular non-current asset. But what I can do here is that I can also prepare a provision for depreciation for you guys, so that you guys have more knowledge of this particular chapter. So if I prepare a provision for depreciation account, how will my provision for depreciation account look like? So after preparing the provision for depreciation, I'll also prepare the disposal account. But let's see the provision for depreciation account first. I'll write provision for depreciation motor van on top. So provision for depreciation motor van. Okay, the balance brought down for provision for depreciation will be this total depreciation at the start of the year, and provision for depreciation is a contra asset account. Contra asset means opposite of asset. So whatever rules we have for assets, we will reverse the rules for contra assets, because contra in English means opposite. You'll write here 1st February 2021. You'll write here balance brought down, and this is going to be 68,000. My balance brought down total accumulated depreciation at the start of the year. So now what I did was that I have disposed of a non-current asset during the year. So it is actually quite simple. What I need to do is that I need to calculate the total depreciation of that asset which I have disposed of. So I basically purchased this asset on 1st August 2019, and I purchased it for 36,000. So that year was basically 1st February 2019. That financial year started on 1st February 2019 and it ended on 31st January 2020. The second year, 1st February 2020 and ended on 31st January 2021. And the third year, that is we are the current year that we are in, 1st February 2021 to 31st January 2022, which means that we have used this asset for 2 years previously. So in the previous 2 financial years, we have used this asset. In the current financial year, you're not going to dispose of this, you're not going to depreciate this asset, because the rule tells us that a full year's depreciation is charged in the year of purchase, but none in the year of disposal. So the current year, that is 1st February 2021 to 31st January 2022, is the year of disposal. So we are not going to depreciate this asset in the year of disposal. What we are going to do is that the accumulated depreciation of this non-current asset is going to be 2 years depreciation. So 36,000 was the cost minus 0 in the first year. We are using the reducing balance method formula. The reducing balance method formula here is cost minus accumulated depreciation multiplied by percentage. So I'll just highlight this for you: cost minus accumulated depreciation multiplied by percentage. Cost in this case is 36,000. In the first year, accumulated depreciation is always 0 because we are depreciating this asset for the first time, and then you multiply this by 20%. So 36,000 multiplied by 0.2 will give me 7,200 is the depreciation for the first year of this asset, which we have disposed of in the current year. Okay, in the second year, this asset we depreciated this by 36,000 minus 7,200 multiplied by 20%. So 36,000 minus 7,200 multiplied by 20% will give you 5,760. So 5,760 plus 7,200 is the total depreciation of this asset which we have disposed of, 12,960. Total depreciation is always written on the debit side of the provision for depreciation account, because we are going to remove the total depreciation of that asset which we have disposed of. We'll write here 12,960. This date of disposal will be 1st August 2021, which we have taken from the question. Then I need to calculate the value for income statement. So income statement in this case, I need to calculate the current year's depreciation. This will be, the date will be 31st January 2022, and income statement value will be, so what I have to do is that at the start of the year, my total cost of non-current assets was 146,000, and from this I sold a non-current asset which had costed me 36,000. So I am left with, so these are the remaining non-current assets, the cost of remaining non-current assets. So this is basically sold, right? So this is the remaining cost of non-current assets. And for depreciation, I need to do the same. From the depreciation, that is total depreciation 68,000 at the start of the year, this also includes that depreciation which that depreciation of that asset which we have disposed of, that is 12,960. So you need to remove this. So once we remove 12,960 from 68,000, so what we get here is 55,040 is my remaining total depreciation at the start of the year. Remaining total depreciation at the start of the year. This has been sold, so this is going to be removed from the total depreciation. Now I apply the formula for RBM. Cost 110,000 minus accumulated depreciation 55,040 multiplied by 20%. So what do I get when I actually work this out? 110,000 minus 55,040 multiplied by 20% will give me 10,992. This is my current year's depreciation for the remaining non-current assets that are coming from last year. Also, I have bought one new non-current asset that costed 49,000, and in the first year accumulated depreciation is always 0. This is the first year for the new non-current asset that costed us 49,000, and now I'm going to depreciate this. So 49,000 multiplied by 20% which will give me 49,000 multiplied by 20% will give me 9,800. So 9,800 for the new non-current asset and 10992 for the old non-current assets which are coming from last year. So when I add these both, so 9,800 plus 10992 will give me 20792, which I'll write as my income statement, 20792 as my income statement. And then I'm going to calculate the balance carried down in this case, which will come out to be 75832. This is my balance carried down at the end of the year. I'll write here 31st January 2022, and this will basically add up to 88,792 on both sides, 88,792, and then this balance carried down will become my balance brought down. This will be 75,832. This will be 1st February 2022. This is going to be my balance brought down at the start of next year, that is 75,832. Now I'll prepare my disposal account, which is quite simple. I simply need to bring this here on the debit side of the motor van account. I'll simply write, the debit side of the disposal account, I'll simply write motor van in the details, and I will write here 36,000. This was the cost of the motor van. So the first journal entry for disposal is motor van account credit and disposal account debit, and this date will be 1st August 2021. And then what I need to do is that in the depreciation account, the total depreciation that I have calculated here is 12,960, which I'll write on the credit side. I'll write here provision for depreciation, and what the double entry that is happening here is provision for depreciation debit, disposal credit. So in the provision for depreciation account, I've written disposal in the details. So in the disposal account, I need to write provision for depreciation, and I will write here 12,960, and this is going to be again the date of disposal, 1st August 2021. 1st August 2021. And then the third thing here will be the money that we have received by check, that is 25,000 we have received by check. So that will be bank debit disposal credit. So in the bank account, I'll write it on the debit side, and I'll write disposal in the bank account, and in the disposal account, I'll write here bank, I'll write here 25,000. Now I need to see if this balances or no. Obviously there is a loss on disposal because my net book value of this non-current asset is 36,000 minus 12,960, which is 23,040. It's a profit. 23,040 is my net book value of this non-current asset. However, I have received 25,000, which is more than 23,040. So that means 1960 is my profit. I'll write income statement on the debit side of this T account. So the journal entry for profit in this case will be disposal debit, income statement credit. So I'll simply write income statement here, and this is going to be 31st January. So this profit is going to be transferred to the income statement on the last day of the year, that is 31st January 2022, and then I will balance this account at 37,960 on both sides, 37,960 on both sides, and then that's it for this question. So that's it for this question. Thank you so much for watching. I hope this helps you guys.